All right, we are live. What is up, everyone? I am super excited to bring us another episode of Drinks in Quarantine and another mining-focused episode. I love sitting down with expert miners and feel so lucky every time we do one of these shows because mining is the pulse of Bitcoin. Like, this is the very root of this thing that we're so captivated by, and when we do these episodes, we talk about like the pulse of Bitcoin. So I'm excited to dive into all of that. Let's start off with introductions. I'm CK. I'm the host. My job is to make sure the drinks flow and the conversation flows as well. I'm going to introduce my co-host, BranBTC. Why don't you give you a little shout out, and then let's jump to our participants, our panel.
Yeah. Hey guys, shout out. It's BranBTC. Cannot wait for this show. We always pontificate on Bitcoin, but these are the people making it happen. So let's throw it over to Ethan.
Yeah, thanks for hosting this again. My name's Ethan. Been on the show a few times now. One of my most favorite kind of online webinars to take part of. So happy to be on. A bit of background on me. I started a mining pool 3 years ago called Luxor Mining. We mine Bitcoin and general Hashrate liquidation platform for it. Also just started a data website called Hashrate Index that has mining related data. And yeah, looking forward to talking mining here.
Special shout out to you, Ethan. You have helped us put these on multiple times, and we couldn't put on these great shows without your help as an advisor. So thank you so much. Next, let's jump over.
I need an excuse to drink here, so.
Yeah, hey, it's Thursday night, baby. Let's jump over to you, Bob.
Hi, I'm Bob Mcelrath. Been in this space for a while. Most recently, I was at Fidelity, helped build Fidelity Digital Assets over there, as well as run the mining operation for a while with my colleague Amanda, who's on the call here. Hi, I'm Bob Mcelrath. Been CTO of two different startups. Been in Bitcoin since about 2010, I guess. Mostly software engineering and cryptography and things like that. And before all of that, I have a totally another career as a theoretical physicist. So I've written lots of papers about Higgs bosons and dark matter and energy. So that's one of the reasons why Bitcoin captivates me. It's all about energy.
Awesome. And speaking of energy, Bain over here on my left just released an amazing piece breaking down how to think about Bitcoin's energy usage. So Bain, why don't you jump in and introduce yourself and maybe tease the piece that you just released on Bitcoin Magazine?
Yeah, thanks. So Tyler. I go by Bain on Twitter. I recently wrote up a quick thing kind of comparing all the various network electrical consumption estimations from like noteworthy sources that I thought, and compiled them together, and I thought to average them all out, see exactly what they how they compared and contrasted, and then throw a couple different alternative ways to calculate it myself. So I thought it was kind of interesting. My professional background is I'm an electrical engineer that works on the power grid, and I'm definitely like a Bitcoin enthusiast and a hobbyist miner. About a year ago, I co-wrote cryptocurrency mining for dummies. So I should probably drink. Cheers.
Cheers, sir.
Cheers.
You're always welcome to drink on this show. Next, let's go over to Cassie. Thank you for joining this mining edition once again. Why don't you introduce yourself?
Hey, yeah, I'm Cassie. I actually am not a miner, so I guess I'm kind of a poser in here, but I'm friends with lots of miners, so I like to hang out with you guys. I have a mechanical engineering degree, so this is kind of like right up my alley. Kind of what drew me into Bitcoin in the first place was the mining aspect of it. But I currently work for a small Bitcoin hedge fund, UTXO.
So Cassie used to do the mining podcast over at Bitcoin Magazine called What's Happening, and one of her podcasts with the head of immersion systems, they just got so deep into the weeds about like the physics of immersion cooling. It absolutely blew my mind. I was like, wow, Cassie, just stop flexing and making us look so freaking bad over here. So you're always welcome on this. I don't think that you're a poser whatsoever, and happy to have your insights. Let's jump over to Jesse. Why don't you introduce yourself?
I'm Jesse Peltan. I'm CTO of Huddle Ranch, and we are developer of infrastructure for Bitcoin mining in Texas.
Always short and sweet, man. Thank you for coming on to the show. And yeah, I mean, Texas is booming. One of our rules is no shilling North American mining. So we're going to at least make it difficult for you to do your job. But we're excited for what you're building. Next, let's jump over to Taras, and then we'll close out with Amanda.
Hey guys, really appreciate being on the show today. Yeah, so Taras, I'm working with Core Scientific as SVP Blockchain Business Development. I've been involved in the blockchain space since 2017. Before that, I was in investment banking in Canada covering tech, but before that, traditional mining. I did a law degree and an MBA, so I've got way too many acronyms behind my name, but I've loved this space since I started within it and really enjoying what we're doing. I mean, I'm not going to shill, but the picture behind me is shill enough, so really appreciate being on the show.
Awesome. And Amanda, why don't you jump in?
Yeah, thanks for having me. I am head of mining at Galaxy Digital, and previous to that, I was director of Bitcoin mining. Worked very closely with Bob at Fidelity. So we have, some mining scars that we've been, establishing and since 2017. So excited to be here.
Awesome. Well, really excited to have you on the show. We've been trying to get you on the show for quite some time, and it's awesome to have you on with this fantastic panel. So really quick, let's just talk about the rules. So the drinking rules are made to be broken, and they're supposed to stimulate the drinking. But the first rule is no shilling North American mining. We all love North American mining. We're all rooting for it, but we want you to drink. So as you shill it, you will drink. Also is no saying Bitmain. So it's our favorite Bitcoin mining company, so no saying Bitmain. And if we say Bitcoin too much, we might implement the Brian Armstrong rule, but I'm going to hold on to that for now. So those are the two rules for now. And yeah, let's get into our first topic. So our first topic is institutionalization. We've talked about institutionalization in mining many times before, but never has it really felt so appropriate as right now, as maybe Bitcoin itself is kind of breaking out as an asset that everyone needs to be a part of, including institutions. I mean, why don't we just talk about like where is the process and institutionalization of mining? When are we going to start seeing big players jumping into the mining game more than they're doing right now? I see Tara's smiling and nodding. Why don't you kick us off?
Yeah, I mean, this is something that I've been talking to a lot of people about since 2018 when I was kicking tires in the most random places around the world looking for good hosting partners for mining. There's been this theme of out of the basement and into the boardroom, and the past quarter has been insane. I mean, you're seeing what happened with the OCC designated Bitcoin as a financial instrument, the past few months around publicly traded companies dedicating part of their treasuries into digital assets and Bitcoin in particular. That whole reason of existence of value exchange has shifted on the BTC side to like a medium of storage of value. And now with institutions really seeing that we're not going anywhere, they're realizing that this is the anti-hedge against the inflation money printers that are going insane again, right? Like right from the very first block of BTC being crafted because of the 2008 bubble. Like this is it. This is like 2008 all over again. So the fact that institutions are finally catching wind that BTC can actually be that value hedge, I mean, it's the perfect scenario of what is the, what's that crucial piece of value that digital assets are providing and is finally playing out properly. That's the MVP that's no longer MVP, but it's actually in adoption and in integration properly. So that's my couple points to say.
A big difference between institutions buying Bitcoin and institutions mining Bitcoin, right? So there's this like educational hurdle. There's this not understanding why, hey, if I buy it, how much Bitcoin could I have gotten in the amount of high capital cost that I had to put up? So I think that I'm bullish on Bitcoin, for all the reasons that you described, but I'm still a little bearish to see institutions jump into mining because I think there's a lot of extra issues that they just don't know and way too many risks sometimes.
Amen. We can't talk with a 600-pound gorilla, so I'll leave that issue alone. I mean, the supply chain is obviously one of the key issues that we're all dealing with. I mean, TSMC moving into Arizona, I think, is going to be a very interesting play. for onshoring of manufacturing capacity. But who knows? There could be some additional issues that prop up over the next couple of years.
That's going to take many years.
Moving to Arizona, will Bitcoin mining get any space of that?
Oh, that's the billion-dollar question.
My vote is
right?
yes.
My thesis has been for a long time that moving to like 9 and 7 and 5 nanometers for Bitcoin mining doesn't make a heck of a lot of sense, right? You're looking for power efficiency at scale, right? You want the most number of chips you can get at the best power efficiency, and that's not at 5 nanometer. It's probably at 16. I'm not entirely sure where the sweet spot is, but there's a big opportunity for somebody to suck up all the last generation 16 nanometer fabs around the world and start making Bitcoin equipment with them. What's Miner already demonstrated this. They were making miners competitive with lower feature size devices at 16 nanometers. And I'm not sure exactly what everybody's feature size is nowadays, but they're not going to be the last.
So what's Miner's at 7 right now?
Yeah.
Well, there was a time there, Amanda, when you and I were working together, 2 years ago, when they just released the
beautiful spreadsheet you made.
Yeah, we should get out the spreadsheet. Where they were running things 16 nanometer. I don't know. Does anybody see that? Anybody on this call? Do you see anybody building 16 nanometer devices left? Or has absolutely everybody switched to the latest generation?
I've seen some people trying to build on 12.
Well, the difference between 5 and 12 is in the eye of the beholder in this industry, right? The 12 is new generation. 16 is last generation. It depends on how they measure the feature size, whether it's the width of a transistor or the width of a line trace. And so IBM and TSMC and Samsung are all measuring it in slightly different ways, since they all claim different feature sizes, but they're all totally comparable.
So I'm very much out of my depth on this, but and this is not really about institutionalization of mining, but I've been very interested to see like the change of narratives around S9s and how they've remained relevant. I don't know if that's something that plays into this conversation at all.
Well, the great migration of S9s has definitely been something to track. I mean, I would be very interested to see a GPS tracker on each one of those, where on the planet most of those are located right now. I mean, it's been a hunt for the lowest cost power for a while now for them, and the fact that a huge number of them are still alive and plugging away is just a testament to that this industry was born global, right? So it's actually been pretty cool to hear about some of the stories of S9s showing up in like the most godforsaken places. But
I want to hear some stories. But like ultimately, I think this teaches us. This is like a teaching moment about how Bitcoin works and how Bitcoin incentives work and Bitcoin's nature. So that's why I'm so interested by it. But yeah, anyone knows any crazy stories about like S9 smuggling?
We're not cops.
Quite a few, like in the tens of thousands, are now arriving in Venezuela. It's definitely one of the bigger locations of arrival right now, and you're seeing that through the secondary channels. We track like the value of S9s over time, and that's been crazy to watch too, because after the halving, they went down to close to $0, and now they're back up like pretty significant. So it really goes to show you should never throw out miners. At worst case, store them and put them in the side of your warehouse, because you never know when they're going to be worth something again. But
when Bitcoin pumps.
I like the term nomadic or like migratory miners. It's pretty interesting.
Yeah.
Well, the goal there is, all right, what do you do with these things, right? So all of the miners have been pursuing these like fixed price power contract, fixed price long-term, 100% uptime power contracts, right? And as we get squeezed on the efficiency and power costs, the older generation miners, can't operate efficiently, right? So how do you actually make them operate efficiently? Well, most markets, at least in the U.S., have a long tail of low price, and this is also geographically distributed. There are areas that are congested that have overproduction of electricity, and so the question is, how do you move into those areas and suck that up? Which I should probably mention, I am still involved in the mining sector. I'm working with a company called Satoshi Energy, so I'll leave that as my my one show for the. And I'll take a drink. To place such miners
are they located in North
appropriate
America?
Places. Yes.
2 drinks.
All right, yeah. Double whammy.
So you guys brought up an interesting thing that I never really envisioned before in my mind, but having migratory miners effectively makes Bitcoin. I know we've talked about the heat-seeking missile aspect of Bitcoin, but also it makes it almost like a energy stabilizer for regions that have these huge impacts of monsoon season, or let's say a volcano erupts or something like that, and all of a sudden you've got a direct incentive to go in and basically eat up that excess energy that gets created there, turning it into Bitcoin. Is that a dumb thing to say, Bob? I see you shaking your head.
No, it's absolutely not dumb, but you don't need anything as extreme as a tsunami or a volcano, right? It happens every day. I mean, I'm sure you've heard that in most markets, the electricity price goes negative at times, right? Why does it go negative? This is an indication of an insufficiently hedged market, right? If people were able to buy and sell appropriately and put in particular short positions on the wrong side of the market, right, this would be completely hedged out. And the reason it's not is because the energy ecosystem is very closed, right? This is how Enron became famous, right? They started shorting all these energy contracts because it is so volatile. I mean, the price literally goes negative, and it also goes above $100 a megawatt hour in most jurisdictions. So this is bananas.
One interjection here. It's volatile on the wholesale markets. Most of these power contracts are very much long-term stable type. Power purchase agreements are for a set price, constantly for many decades in some cases. So yes, the wholesale market is, and those prices fluctuate, drastically. Some cases negative with excess power. That occurs every day. But the actual power prices that a lot of these companies, distribution companies, transmission companies, they're locked in for multiple decades from their power purchase agreements and providers. So it's this kind of odd, that somehow there's a lack of connection, or it's disconnected from reality. The reality is the price fluctuates on a minute by minute basis, but these companies are fundamentally locked into contracts that don't. So sorry to interrupt. I just wanted to interject.
Well, that's all right, but you made my point for me, right? So people have been seeking these long-term contracts, but we're going to tap that out, and maybe we even already have. But there's a very interesting use case for Bitcoin miners as a variable load, right? So when the power price drops to the floor, why not buy that power at negative prices or very low prices, right? Because you can turn on and turn off miners very, very quickly. It's a variable load, right? These, all jurisdictions have some kind of demand response, right? Which is, generators turn up, load turn down, and there are signals in the power grids for doing this, usually via the frequency. So Bitcoin is an interesting way to insert demand response in any market and help hedge out and make the power price smoother.
Totally.
Yeah. Isn't this what Layer 1 was really trying to solve with their battery systems, that nobody actually knows if it has shaken out and proven in a real life setting?
I wish there was someone on the call that knew a lot about Texas energy.
Anyone named Jesse?
Yeah, Jesse, do you want to talk about that?
Yeah, so I mean, in general terms, I think Bob's totally right about Bitcoin mining as a variable load. You can respond in seconds and change the amount of load that your Bitcoin miners are pulling from the grid. And that can be useful for a number of demand response programs or real-time pricing-based arbitrage. So there are plenty of firms that do this. This is not unique to Bitcoin mining either. I mean, this is something that you'll see in a bunch of different industries, depending on what grid they're located in. So in some grids, you'll see this with aluminum smelters, where it's a similar sort of thing. They'll tune up or tune down the amount of load that they're pulling to provide that same service to the grid. And it's really one of the most efficient ways to do this. Your alternatives are things like peaker power plants that you have to build out to only run a few hours out of the year, or batteries, which are still very expensive and don't have the scale that's necessary to balance the larger grids in the world. So the demand response is a really interesting one. There's not a ton of loads that can do significant scale of demand response. So the Bitcoin mining is a really interesting use case for that. You saw some of this happen in more of the traditional data center industry, but not at the same sort of megawatt scale that Bitcoin is capable of.
Absolutely. Yeah. I think that's 100% correct. I'm fairly familiar with the ERCOT grid. we're just north of there in Colorado. Just like a point of reference, we have about like 16 to 18 megawatt hours of battery storage on our local system. We're not that big, but we have quite a bit of battery storage just to do exactly what you were just explaining. Charge them in the evenings and discharge them on peak times. And honestly, our rates are built at our electric utility. The rates are built to incentivize load shifting, to incentivize people to not turn on their washer and dryer or, stove or oven during certain periods of the day, typically between like 4 and 8 p.m. And then, during the rest of the day, the energy's dirt cheap. It's really those 4 hours. It's just like incredibly expensive with demand, KW charges instead of KWH, like energy charges. So I think it's one of those big important things is like power instantaneously. The watts are expensive certain periods of the day, but in general, the kilowatt hours, the energy is incredibly cheap. It's a commodity. So Bitcoin mining, electric vehicles, you mentioned like industrial, like thermal processes, a lot of like steel and aluminum. Those types of things can typically shift loads. We have actually an aluminum recycling plant right down the road, and they don't shift their loads because it's not economic for them. They have to stay running 24/7.
Yeah.
So like if you have the most efficient Bitcoin miners, you're probably not going to be participating in a demand response or a load shedding or load shaping regime, because that Bitcoin miner needs to be running to be profitable 24/7 regardless of the electrical costs. Whereas if, like you were saying, those S9s, you could run an S9 on Colorado's electric grid, but if you turn it off between 2 or 3 hours of the day, you would be profitable. So there are really these S9s, the energy cost is cheap, the power demand certain periods of the day is expensive. Huge opportunity for Bitcoin miners.
So I've got a question about this specifically, because I feel like we're going back a little bit to what Bob was saying earlier, and I want to clarify because I just don't understand this well enough. But you were talking about even looking at the 16 nanometer chips as opposed to like these 5 nanometers that are coming out right now, and that there's actually it's more efficient to use kind of the older version chips in some instances. Can you kind of explain like I'm 5 or maybe explain like I'm 12 why it would be like more efficient to use older, less ingenuity, less innovation chips?
Certainly. So let me first kind of recap on the previous question about S9s, right? So S9s are going to move to areas where there is demand response, right? And they're going to have to curtail for part of the day. There are a number of places in the world where the power is structured that way. And you can get very cheap power that way. You can afford to have a rather inefficient miner. But what you get for that is your inefficient miner has a low CAPEX, right? So right now, the latest generation of mining equipment is set with the price as proportional to the Bitcoin price. The mining companies are raking us over the coals for the price of those brand new miners. They're sold at a very significant price premium compared to how much they cost to manufacture. If you're willing to go to last generation's equipment and let's say run them at a low clock rate, you balance this. There are only 2 numbers really in mining. There's OPEX and CAPEX, right? So if I'm going to spend $3,000 on a piece of mining equipment, I need to plug it in 24/7. It's got to return its CAPEX, right? On the other hand, if I build a mining device for, let's say, $300, brand new device, let's say $300, which is not outside the realm of reason for, if you use the older generation ASIC equipment, old generation fabs, all right, it can be a lot less efficient, right? And that your profit equation between CAPEX and OPEX, you're spending more on OPEX, but you're spending a lot less on CAPEX, right? So to your question specifically, there's a phenomena called gate leakage. Now transistor is a very small device, 5 nanometers across roughly at the latest generation, somewhere between 5 and 10 nanometers. Now, gate leakage is where the electrons that are supposed to be going through the transaction actually leak out the gate to ground, right? So you lose a considerable amount of power by doing this, and this basically disappears as heat. And the smaller your transistors, the more this is. The difference between like 16 nanometers and 5 nanometers is more than double the loss to gate leakage, right? So this is power loss that is not directly contributing to your computation. It's not actually contributing to Bitcoin mining, right? So there's 2 competing things here. One is I make the feature size smaller and get more transistors in a smaller space. but now my heat density goes up like crazy, and I'm spending a lot of my power budget on gate leakage. And now I have to dissipate more heat coming from a smaller area. An individual transistor creates less heat because it's smaller, but it has less efficiency as well. So, we're going to hit a point here. I'm not sure if we're there yet. I think we probably are, where going to smaller feature size doesn't make sense from an energy efficiency perspective anymore. Maybe it does from a speed. So, you're always going to see cell phone processors, computer microprocessors pushing for that smaller and smaller feature size because they can get more speed that way at the expense of energy efficiency. But in the Bitcoin market, we really don't care about speed. It's as is said in computer science, it's an embarrassingly parallel problem, right? There doesn't need to be any communication between the chips really, except at 10-minute intervals. And I can have lots and lots and lots of them.
We don't care about speed as long as everyone else's speed is the same or relatively the same as ours. Because if one miner has a machine that is significantly better than you with better OPEX, right? And if that's like a majority miner, then you would care because you wouldn't be able to compete.
Completely agree. What I'm saying is, like, at the chip transistor level, it takes a few microseconds to compute a SHA-256 hash, right? Mm-hmm. So if it takes me 1 microsecond, it takes you 3 microseconds, but you have 3 times more chips. We are equivalent miners, right?
And it's really the pipe that's connecting your chips to the actual network that really makes the big difference, right? I mean, it's the connectivity that also your chips can be as fast.
Well, assuming all else is equal, assuming all of that is equal, is what I'm saying.
Sure.
I think he's talking about hash rate speed as opposed to latency, like network latency speed.
No. Okay, so I'm talking about number of hashes you can perform per second, right?
Absolutely, yeah.
So
yeah, okay.
If I have a latest generation device that I'm clocking at 600 megahertz, right? If I clock it at 200 megahertz, I'm going to compute 1/3 as many hashes in an equivalent amount of time, right? Now, if that brings my power cost down significantly, it might be worthwhile for me to do that, right? And so I'm, to Amanda's point, the two of us could have exactly the same hash rate, but I'm using equipment that's clocked at 200 megahertz. She's using equipment that's clocked at 600 megahertz, right? Or one of us is using 5 nanometer equipment, the other is using 16 nanometer equipment. There's a number of variables you can tune here. And when I say fast, I mean, how long does it take to compute a single SHA-256 hash, which is microseconds, right? And you don't really care whether it's 1 microsecond or 3 microseconds because it's parallel.
All right, well, that is absolutely fascinating, and I definitely learned something right there. I hope people tuning in learn something as well, because this is a whole different world than us normies ever have to think about. So I wanted to actually take a step back. We've kind of dove deep into the efficiency realm, but originally the question and the topic was revolving around institutions getting into Bitcoin, right? And specifically getting into Bitcoin mining. And Amanda was good to kind of make that distinction. And so I guess I want to repose the question in a bit of a more pointed way. And let's start with Ethan and then go to Amanda and then to Cassie. But could we, do we see institutions, a little zigzag pattern, do we see institutions getting into Bitcoin mining as a good thing or as a bad thing? And Ethan, can you kick us off?
Yeah. The first thing I wanted to discuss, though, before we jump into that is, like, what do we define as an institution? Is this something like Fidelity and that's it? Or do we consider, like, the big crypto players institutions? Or do we consider hedge funds that are buying, 20, 40 petahash worth of machines and hosting them somewhere in institutions? So I think legacy institutions, like, there's still very little participation to date. Fidelity is probably the prime example of that, but in the kind of public sphere, very little. And then privately, there are some smaller institutions, hedge funds, family offices that are getting involved in mining. So I definitely think it's a trend. Probably Amanda and Taras can comment better on this than I can, but I think it is coming for sure. And those types of institutions will continue on. I'll leave it there, then we can return back to if it's a good thing or not.
Being an institution trying to get into Bitcoin mining, right? And okay, like, give me millions of dollars. I'm going to quickly wire this money to China. I don't know. We might get the machines in January. We'll see. Like, I don't know. Maybe. It might come in February. We have no contract. And if we did, it was in Hong Kong or China. Like,
better than it was 2 years ago.
Kind of better than it was 2 years ago. Still kind of, like.
Better than Butterfly Labs?
Yeah, but Butterfly Labs.
GMO?
Yeah. GMO.
Started from the bottom, now we here.
But do
Oh,
these
you guys
like
are too young to remember Butterfly Labs.
do these financing packages change that though? Because now the risk is put on the financier or the colocation provider.
Institutions don't want to finance miners. They have their own money. They don't want to give you any interest. They have plenty of cash on their own. That's the whole reason why they can get into things, right? And the leverage that they have. So I would say that I think there's this romantic view of oh, this is going to be great. Institutions will get into mining. This is awesome. But when you go through how you have to do that from an institutional perspective, there's so many risks that it's very hard to get an institution to say yes to that. Never mind say yes to Bitcoin. Bitcoin mining is this very weird little area that you can't bring in an expert to tell you this is exactly how this works. And I've been doing this for 30 years. That doesn't exist in this world. And unfortunately, that's what institutions rely on and need.
Kodak made the jump.
Oh my God.
Oh boy.
Kodak is still trying to get that for their huge fail of digital.
Digital cameras.
I think that one of the things that's interesting is the miner financing, and that's I think more for the smaller companies that are already into mining. We at Galaxy refer to that as MiFi, which is a fun little twist on just DeFi and every other kind of fi that works in the world. MiFi. And we've seen MiFi loans that have already existed in the past, and hopefully that will help some of the larger companies that are into mining get the financing and capital that they need. I just don't see Goldman Sachs jumping into Bitcoin mining anytime soon.
Well,
what would take them to get them to do that? Yeah, all right, Bob.
So there's another side of this coin, right? And that is Bitcoin, the asset itself, right? And we've had some interesting developments, right? Today, PayPal announced that they're going to let you pretend that you have Bitcoin in your PayPal wallet and never be able to withdraw it. So there's
that sounds like Robinhood.
Exactly. Yeah. So
everyone should link to that.
So why did that happen, right? And we can apply that. We can apply why it happened to the mining space as well. So PayPal got into it. Square got into it. Fidelity got into it. And at every single place, their lawyers looked at it and says, AML, KYC, blah, 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 and they got freaked out, right? This happened at, let's say, some large institution I used to work at. I've been through this with all of their lawyers and their compliance people and watched the freak out, right? They just got started early, right? But somebody who's just getting into this now is going to have this freak out with their lawyers. Now, the OCC announced that basically all banks in the United States can now custody cryptocurrency. So mark my words, every single bank in the United States is looking at, can we do this? Should we do this? Why should we do this? And they're having this freak out right now.
That's very different than mining Bitcoin. That's my point.
It is. However, now let's apply that to mining, right? Let's say you already accepted the Bitcoin investment thesis and now you want to get into mining, right? And now you have a similar freak out on the mining side, right? And there are, so first of all, you got to get over that hurdle that all the PayPals of the world are having. And some they're going to do it correctly. Square's doing a great job. Fidelity's doing a great job. PayPal, not
Square
so much.
and Fidelity, top notch.
But then you go to the mining side. All right, you accepted that. Now I want to do mining, right? There's a lot of complication. One thing I've heard over and over from investors and frankly power companies is that this space is sketchy. They have a lot of people come to them and give them these proposals, and it's just not what they're used to. It's not. They don't know how to evaluate. They don't know how to do due diligence on these people. Who are these people? Do they have a bank account? I don't know. So there's a legitimacy problem. There's an education problem. The power companies don't know what this is. A lot of what we do is going around educating. There are accounting problems, right? How do I value the cryptocurrency, right? If Bitcoin goes up, does that mean I have a profit and loss that I have to report? If it goes down, do I have a loss I have to report, right? There are some serious accounting problems in holding Bitcoin. Then there's things like, let's say I have multiple parties coming together. I have a financier and a miner and a power company. Those are the minimum 3 parties that could be involved, right? Now I need a tripartite contract, and I have to set up who gets paid when and how. This is serious business, right? So far, the miners have been doing this kind of in a fly-by-night way, where I am the miner, I'm going to get the Bitcoin, just give me power contract. So there's not a third party involved, right? So bringing in that third-party investor, he needs a tremendous amount of due diligence, accounting, reporting, and legal contract structure for the other two that I think by and large they have not had.
Amanda's raising her hand. Go for it. Wait, Amanda, and then Cassie, because Cassie hasn't gone, but go for Amanda.
Let's also talk about then like forecast
muted, by the way.
model of a Bitcoin mining operation. Okay, you're like the machines might last for 3 to 4 years. They could last longer. We don't know. The depreciation schedule could be X amount. Can't control hash rate and price, but hopefully we'll make some money, right? Like that's just very antithetical to how every single institution is used to things and how it works. That was it. That was just my little
Good point.
Cassie, you've been talking to maybe not miners, but outsiders and trying to sell them on Bitcoin. Like, what are these conversations like, and what's the institutionalization like, maybe from Bitcoin as an asset, but also from a mining perspective?
Yeah, a couple of things came to mind, and I would say, I think that a lot of these are big concerns in terms of institutionalizing mining. I think the biggest is that it's not just like mining in and of itself. It's like they're entering into a completely different industry that most, financial institutions have no experience in. Like they don't have experience typically in any sort of like data center or data processing. That's just not really in their wheelhouse. At least these like major banks. That's not something that they really dabble in, right? Like they're outsourcing all of that. So for them to take that stance, that they want to make a leap into not only this niche that is, hyper focused, but it's an entirely different industry vertical. And then it's a subset within that vertical that they would be making a leap into. It's not necessarily, in my mind, the accounting that's super difficult. Like on a hedge fund, you just pick an accounting basis and how frequently you want to measure that. And it's unrealized gains from month to month, and you have, you can usually outsource that pretty easily, but I'm sure that they offer those services in-house anyhow. So there's a lot of different softwares that are being built around, accounting for miners, and lots of things that are kind of easing those mitigations. But I think it's just the entering into a new industry entirely that is the biggest hurdle for them. They wouldn't, they might be brokering a deal between, two people someone who is selling a car factory, and someone who's purchasing a car factory, but that doesn't necessarily mean that they want to go out and own and operate a car factory for themselves.
Well,
yeah, and sorry, go ahead.
No, go for it.
I was going to say, I mean, in the industry, you're actually saying a bifurcation of operating models, right? Where the hosting providers at scale, sorry, I'm shilling a bit, are getting really good at hosting large scale fleets, right? Optimization of firmware, automation of OPEX, so that literally the only time you touch a unit is actually when the hash board burns out or something physical needs to be replaced. And then you have these pure plays where they're spending all of their capital on CAPEX, which is really inventory, and just running as many machines as they can and outsourcing that secondary service to somebody else that's an expert at it, right? Sorry, I'll have another one. And this type of risk differentiation is really giving the market the ability to get exposure to one type of operating model versus the other. And I think that's really going to continue to happen as the market really evolves and matures and institutions do get into the space. And I defer to Amanda, sorry.
No, I said I think you're just looking for an excuse to drink. I'm not sure if you're
That's all of us.
I want to
couple things.
Can I ask a question?
Wait. Let's let Tyler go, just because he's been trying to
just real fast. Just something. A couple comments. So not to give the banks too much credit. Never do that. But I do know they do have data centers. They've got their own data centers now. They've probably got quite a bit in their wheelhouse that maybe we don't give them too much credit for.
One data centers, right?
I'm not sure, but yeah, I do know they've got them. I don't know. They've got their own self-hosted.
Amanda and I tried to use such data centers.
Nice.
It's a lot more difficult.
Not that they're
than you
good.
might imagine.
Redundant power with higher build-out costs. None of those things are useful for Bitcoin mining.
Oh no, I'm not saying they're very comparable. I'm just saying that these banks do very well. They do have data center experience. I wouldn't say a Bitcoin mine is. If you deploy a Bitcoin mine as a data center, you're going to have some problems. I agree. But
when you have those conversations with the data center groups at large companies, they're looking through it a different way.
Yeah, absolutely. But I do know that they have that experience. And then one more thing on what Bob was talking about. Speaking from experience from the power company side of things, I'm a member of this. It's an organization called IEEE. They're like they're like this institute for electronics engineers and all these things. Well, IEEE has this blockchain association or some whatever. Well, it's supposedly would be this like industry facing blockchain initiative, kind of from maybe some of these utilities and huge power providers perspective. I went to a couple of these things. They're lost. They don't totally understand Bitcoin. They don't really understand the technology or the ramifications. I would agree with what Bob was saying with as far as utilities, just misunderstanding a lot of that. But just from perspective, not all utilities, there's a lot of them, but most.
Education component is everywhere, right? To circle back to the question of like, okay, so these big companies do have data centers, right? The education component exists there too. I mean, you walk up to a guy who's been building data centers, for rack-mounted, U1 servers his whole life, and then you say, I want 50 megawatts. He's like, I've never seen a data center that big. No, how many U1s does it take to get to 50 megawatts, right? That's a lot, right? Okay, so maybe Google and Facebook are doing that, but not any bank, right? The amount of computing power that any major financial institution needs is not that large. A lot of them are still using mainframes, and those consume some pretty substantial power, but we're still talking like sub-megawatt, right?
Well, this is something that Christy Minahan has talked about on this show before, is that Bitcoin mining in particular has really pushed the envelope on data center design, server computer design. Even like the ASIC shape is starting to become adopted by not Bitcoin mining use cases.
Okay, don't do that. The ASIC shoebox shape is stupid and needs to die.
Well, not according to Christy.
Well,
but
wait, Jesse, do you have something to say about
that?
that?
Show of hands. Are shoeboxes stupid or do you like them?
I love shoeboxes.
Let's see it. No, I want to see a show of hands now. Bob has challenged the group.
It's home. Like, that's home. Like,
Amanda says yes.
Yeah.
You put your shoes in the box.
Man, Bob, you're on the losing end of this. Okay, Jesse,
with your 3 kilowatt
let's get you involved
power cable.
here.
Good luck.
Let's pick that brain on this topic. How has Bitcoin mining like pushed the envelope on just data centers?
I would be hesitant to say that Bitcoin mining has pushed the envelope. So in terms of scale, yes, but in terms of technology, no. So like Facebook, Google, Yahoo, they've all built open air data centers that utilize the same sort of open air free cooling that Bitcoin miners do. They see similar PUEs. They have much better environmental controls. So I think if anything, you're going to start to see Bitcoin mines approach enterprise open air data center design, specifically because we've seen this lengthening of hardware cycles where, when you first had ASICs coming out, you'd have a new ASIC come out every couple of months. They'd be obsolete in a year. That's not the case today. As we've talked about earlier, S9s today are still profitable in low cost power regions. They came out in mid 2016. So, over 4 years later, they're still running. So having a design of data center that's conducive to long server lifespans is becoming important. It wasn't important in 2014 or 2015. And if you had built a data center that way, you would have just misallocated capital. So we're definitely seeing a transition in the market now where it's going to be prudent to spend a little bit more on your infrastructure upfront than it was in the past, just because we are seeing longer server lifespans. And that technology is not going to come from Bitcoin miners. Like, that's already been very well developed and established. Hashrate has specifications that everybody should meet for what different types of equipment in a data hall is supposed to, what ranges of temperature and humidity, et cetera, they're supposed to be maintained. And that science was all developed well before Bitcoin miners started.
Yes, totally. I would agree with all that sentiment. But one thing, is like what we were talking about is what Bob said as far as like banks and their knowledge with these things. It's a totally different animal. I think the power density alone for like a Bitcoin mine versus like a traditional data center, they're almost not even comparable. And so I think different. Yeah, and I think as far as like open air cooling and then like submerging like liquid type cooling, I think a lot of that Bitcoin has kind of pushed the envelope, or Bitcoin mining in general has pushed the envelope on a lot of those technologies. If you would have told someone 7 nanometers a decade ago, before Bitcoin's existence, that was like just commonplace, I think a lot of electrical engineers would have.
I don't think that Bitcoin led in any of those examples though. So for example, like 7 nanometer, right? So TSMC made 7 nanometer. Apple was one of the biggest customers of that. As far as 5 nanometer goes, Apple bought all of the 5 nanometer. So Bitcoin is not what's pushing the envelope in terms of process technology. Even in technologies like a lot of the stuff on immersion cooling, there's been a decade of experience in the traditional data center industry where you're like the biggest immersion builds. I mean, I'm not aware of any that are larger than this, but you still see
the power industry has over 100 years of experience in immersion cooling.
Let me just jump in really quick too here, and I think that like I like to find teachable moments in like trying to understand Bitcoin's nature, but like I think maybe we're even thinking about this wrong. Like, how is Bitcoin pushing the envelope on preservation of existing technology? Maybe the better way to think of it, like there's all of this infrastructure built around doing things in one way, and Apple's moving on, Apple's iterating, they have the cutting edge, and Bitcoin's pushing the edge on how to preserve that existing infrastructure and make create value out of it.
Well, that's kind of my question. Like, what's going to happen to the 16 nanometer fabs, and are they going to produce chips at a volume that they did before the 7 nanometer fabs existed? Could they? Who will do that? Is Bitcoin mining part of that equation?
Yeah, I'm a little bit hesitant. So I agree with part of the thesis here in that there are multiple ways to achieve a specific chip efficiency. You can have a different process size, and you can have a different clock speed that requires a different voltage. So you can achieve the same efficiency through more than one method, but I'm a bit skeptical that Bitcoin miners are going to use significantly old processes. Like they may use a process that's one old from the cutting edge, but the demand on those processes drops off dramatically. So I would be skeptical that Bitcoin miners would go significantly farther back. What you saw back in the day when ASICs first came out is that Bitcoin miners did use the oldest processes or very old processes because there was basically nobody on them. They were super cheap.
Production.
And then
cost of production.
Yeah, and and they were way better than mining on a GPU or an FPGA. But what we saw is over time that caught up specifically for that efficiency reason. Now, if you were to see some big bull run in Bitcoin, if Bitcoin had another 20x year, yeah, you would definitely see a ton of 16 nanometer chips getting printed. But I think that in terms of if we're moving along at sort of a sideways market where there's not a lot of upward movement in Bitcoin price, you're going to be driven primarily by efficiency. And I think it's going to be very difficult on a 16 nanometer chip to get the same efficiency as a 7 nanometer. Like an underclocked S9 is about halfway between, in terms of efficiency, between a stock S9 and an S17. And
so let me state the following as a physics theorem. At some point, as you go to smaller feature sizes, you lose more to gate leakage than you actually get from computation. Right? So there is an absolute lower limit here, even if we keep pushing to lower and lower feature sizes, where the power consumption will start to go up as you go to smaller feature sizes.
Yep. But and I mean there's a couple parts to that, right? So there's like at the point where you start seeing significant power consumption increase, you're going to see that happen not just in Bitcoin mining, but in any sort of simple parallelizable problem. So I think you start to see that on GPUs as well, where you might see GPUs that use an older process than the very newest one. And then the other thing that you'll see with that is that once you get to a certain point, it may not even be worthwhile for any process to go to significantly smaller. So for example, if your leakage gets high enough that limits your frequency, then you're no longer even useful from a CPU perspective.
Yeah, but
you do it for speed.
Well, so
not for efficiency.
Sorry, can you repeat that?
No, I was gonna say I think that is like the MOSFET design, right? That like we're on right now, and there's like different designs that could potentially come out, like the gates all around design, Jesse, that I know we've talked about quite a bit. But zooming out and thinking about it from a business perspective, from like say MicroBT or another type of manufacturer that's on the list of words that we can't say, if every single node, right, that you try to test out, like every design that you test out at your fab costs about $10 million, right? So if you're testing out these nodes and some of them fail and some of them make it, you need to make back that money on that node. So I don't see like I feel like the innovation is going to continue happening on the nodes, and the manufacturer has to make up for the money that they put up to get that design up and running.
Which is why, like the old generation stuff, I think is still an opportunity, right? Even if we're nowhere near this point of minimum power consumption on the future size, simply the capex on old generation stuff is much lower, right?
The only point of caution I would have there, so you can definitely have lower capex on a dollars per terahash basis, having an older process. But you also, efficiency is still going to be vitally important, because the other thing that becomes a bigger factor, especially if you're starting to have something that has a lower uptime, is the cost of your balance of system. So all the rest of your supporting infrastructure that supports that ASIC. So this is, for example, why it often doesn't make sense to overclock an ASIC, even if there is significant headroom on it. And in fact, you see a lot of people underclocking something like an S9,
Exactly.
where even if that marginal increase in hash rate could theoretically be profitable at free infrastructure, at whatever marginal price of electricity, you have to build additional supporting infrastructure, and it's an increasing cost for every megahertz of frequency that you add to that processor has an increasing energy cost. So same thing with, like, if you're going to an older process, you have to have more supporting infrastructure for that same amount of hash rate, and that equation can get to a point where it doesn't make sense, especially if you're running at a 80% uptime in some area where you have not relatively intermittent cheap power.
I think like, just to weigh in on this kind of debate, I think Jesse might very well be correct on like the manufacturing, like from a manufacturing perspective, but I think Bob might be correct from like an operational perspective. If these 16 nanometer machines are in existence already, they're very much, there are places where they are profitable to operate. Doesn't mean maybe that they're, as profitable to manufacture. It just depends on the cost, or, cost of manufacturing, I suppose. But I think operationally, they've got a lot of life left, crazy as that sounds. But maybe manufacturing.
I mean, the current demand for S9s is an indication that this is true, right? I mean, again, there are only two knobs you can turn in mining. You've got CAPEX, you've got OPEX, right? And I want to have control over both of those for different business considerations. I will turn one up and turn the other down, right? And other things for vice versa. If I want to do demand response, I want high OPEX and low CAPEX, right? If I want to, I'm not quite sure what the thesis is for high CAPEX. I think you're probably underwater, but there are people who are doing that, right?
Yeah, no, I agree that there's definitely a use case for older generation miners. But I think what you see is the areas where these miners are going to are not places where you have sort of like top of the line build outs, right? These are places where these miners go to die, like both economically as well as just from a reliability standpoint, from a physical standpoint. They're put into conditions that are super cheaply built, where they know that this machine is going to burn out in a year or so. And that, you can get enough economic value out of it that can still be worthwhile, and you just go replace it with another machine that costs nothing. But that's a bit of a different side of the equation. And I don't think that's ever going to be, that's never going to be the majority of mining. It's always going to be a smaller portion, since it only works when you have this large supply of machines that are basically worthless if they don't get plugged in somewhere. And you can provide some amount of value out of an otherwise worthless machine.
It's the long tail
I disagree
of
with
the entire
that
ecosystem itself. It's the long tail.
It is the long tail, but think about what happens macroeconomically and globally, right? If everybody's going to these power contracts, everybody's getting these long-term power contracts, right? It raises the price of power, right? Everybody's paying more for power, right?
I don't think that we're even close to the point of raising the price of power from Bitcoin.
Well, I would agree with that, yeah. But
talk about institutionalization.
I think long term we are going to be looking for more and more ways to curtail, operate part of the time, and find cheap power.
No,
And that's not newest generation stuff.
So I want to do last word on this specific topic, and then I want to transition to ASIC landscape. You wouldn't believe it, but we're already an hour in, and we're just into the first topic. So I think we've touched on this a little bit, but anyone want to close out talking about institutionalization?
Listen, Jesse.
Yeah.
Wait,
We,
Jesse, what were you going to say right before that? And then let's go over to Ethan.
So one quick thing that I was going to say. So just like there's a long tail in terms of the mining, that you see this same sort of Pareto distribution in terms of the value of that grid balancing service. So even a new generation machine can afford to turn off a couple percentage of the time when you have these really high value hours. Like if your new generation machine is bringing in $120 a megawatt hour or so of revenue, in a lot of grids, there are times when power goes into the thousands of dollars per megawatt hour. So it can still be profitable to turn off a few percentage of the time. And those few hours contain the most amount of value. So there's a long tail to that as well. And you'll see that happen with, over time, like these machines will run at a lower and lower and lower utilization rate. But I think there's room to have new generation equipment and still do this sort of grid balancing thesis.
Any final words on this subject?
Ethan?
Just quickly, yeah. And Harry kept messaging this in the chat. It depends on price. I think this is the big thing, right? Like the new gen versus old gen debate. At the end of the day, both new gen and old gen machines fluctuate significantly in price. So it's all about when you buy them. You can get either of them on a really good discount depending where you are in the cycle. Like these things change price 5 to 10% per week. So you could buy old gen machines at a high price and still kind of mess up this thesis. So that's my last word on this. But back to institutionalization, I think a really interesting last topic here is like, is this actually a good thing for mining? And who is it good for? Is it good for co-location providers? I would argue yes. Is it good for manufacturers? Probably yes. More demand. Is it good for pools? Probably neutral. They don't care. Is it good for existing miners? Probably no, because like now they're driving dollars per terahash down below 10 cents. Is it good for Bitcoin? What do you guys think?
2 thumbs up.
Is
3.
having people like Fidelity come into mining, like more institutions like that, like Goldman or other banks, like is that good for Bitcoin?
Yes, absolutely.
It's anti-fragile. Yep.
There's a
Exactly.
diagram that shows how things work, and it's, is this good for Bitcoin? And then one route, and then yes. So I tend to agree with that. I want to talk a little bit about the ASIC landscape. We kind of touched on it a little bit. We talked about nomadic S9s. We talked a little bit about manufacturers raking miners over the coals for the newest generation devices. Like, what is the current landscape? Like, is What's Miner the king? Is Bitmain in the gutter? I'll take a drink for saying Bitmain. Like, who wants to kind of give us an overview? Amanda, I want to jump to you. I don't know how much more time you have left, but maybe you can kind of give us what you see as the grand landscape of ASICs.
So, I think the thing that happened, last year that really set What's Miner apart is adding more customer service features. So up until this point, right, it was, you kind of have to you get what you get, right, from Bitmain and What's Miner and Canon and Canon and eBang, et cetera. But
eBang.
What's that?
No, I'm sorry. I love that name.
And so, What's Miner was saying, hey, we have tiered pricing schedules. If we deliver your machine late, we'll honor that. We'll have the warranty last more than 6 months, a full year. All of those things are really good for Bitcoin miners, right? Because it de-risks us a little bit. So to me, those features, plus their chip being really superior, is amazing. Then on the other hand, you have Bitmain, who still has good features. They have a facility outside of China. So for North American miners, we don't really have to worry about the tariffs that are massive right now for us. But like, who are you even ordering from? There's like 2 companies in one. Like, no one understands what's happening. They're throwing each other in jail. They're throwing like the What's Miner guy in jail. Like, it just seems very childish. And so
Dr. Young, by the way, it's Dr. Young.
Dr. Young, he's a nice man.
Welcome to
He's a very
2020.
nice man.
Yeah. And
That was the name of the day.
it was, it's one of those things where, to me, the customer service plus the machines being extremely reliable, plus, you know, them coming out with a new facility outside of China will really position them to be the leader in the space.
Out of
What
curiosity, in
what's-
North,
Wait, just really
And-
quickly, what's miner specifically? Is that what you're saying?
Yeah.
Out of curiosity, if you wanted to like cash in on your warranty in North America, what does that process look like? Like, what's the length of time for them to get out to you and service your equipment or send you another part?
So I haven't had any negative experiences with them whatsoever. I imagine that it has to do with the relationship that you have with the manufacturer. And so I imagine that maybe there's some small miners that have a very different experience than I do with it. I usually send them a WeChat message and things get fixed. You know, so I don't know, you know, maybe Tyrus, if you've had a different experience because you operate a much larger scale and you have clients at different size than I do, but I imagine your experience must be relatively similar to mine.
Well, I know the MicroBT guys personally, based on my experience back in the day with them. That being said, I mean, I think that the space is actually getting a lot better, that we should be seeing a lot more stability over the next few months. I don't want to say any names specifically because of the sensitivity around it, but I think things are getting a lot better. So delays are getting shorter.
Is it Kodak?
It's definitely Kodak. It's one of those Kodak moments, so take a picture. No, but candidly, there has been a lot of delays in the past, and especially the past 3 quarters. There's been a lot of tumultuous situations that have hit the news, and it definitely has left a huge black eye on the entire sector. Over the next 3 quarters, I think that's definitely going to shake out because the folks that have the most to lose have realized how much they've already lost, right? So I think that there is light at the end of the tunnel, and that light's actually approaching really quickly. And that's one of the things that some of the institutional folks that we're talking to, sorry, I'll need to refill, are seeing in the space. So the supply chain is definitely tightening up. Regarding repair times and turnaround times on that, it's still terrible. There's still months and months delays around existing units in warranty. So the sector is working on it. I mean, it's going to get better, but it's still terrible right now.
It could be a lot better, right? To a previous conversation we were having about like where is the tech revolution coming from? There are a couple of elements I was thinking about in that conversation. One is DC power supplies, right? So Google has pioneered using DC power supplies in all their server farms, right? We've still got these AC power units attached to each of the mining devices, and that's where most of the failure rate comes from. Is those stupid power converters, right? And we're losing a couple percent in efficiency right there. Immersion cooling, power industry's been doing it for 100 years, et cetera, et cetera. But for warranty, really for the Bitcoin mining industry, it all comes down to hash rate. If you lose a couple percent in hash rate, how much do you care? How much labor are you willing to invest? How much are you willing to pay someone to go in and fix something? There should be a much, much simpler way to do this by treating it as a commodity and saying simply, how many failed hash boards do you have? How many failed power supplies do you have? And I'll set your replacements. Boom, done. It could be a lot easier. And maybe even not that, right? Maybe if there's a hash rate decrease by a certain amount, you have some kind of bond or something where you essentially are paid back because you're making 3% less profit. Okay, darn, but that shouldn't put me underwater.
Do you think that would be like a separate business model, run kind of third party? It's like an insurance for manufacturers, basically.
Could be. I mean, other industries have a network service. If you look at IBM, right? IBM has like a series of like service centers, right? Imagine a business that just stacks a bunch of hash boards and power supplies, and simply. And I imagine many companies actually do have this. But the point is, I don't know. There's really only 2 things: replace my hash board, replace my power supply, right? And you need to be able to do it yourself. Don't ship it to us. Don't ship me a broken mining unit, right?
Sometimes it's fans, but yeah,
fans too.
There are mining manufacturers that will do this on large orders. Well, they'll send you a couple extra percentage of power supplies and hash boards, knowing that you're going to have some failure rate. And then what you do is you contact them when they fail, and you ship the old one back. And then you've got this little store to where you're hopefully not down while they're going and actually working on the other one or shipping you a new one. So
Absolutely.
Those
there,
are really larger orders, right? It's not.
Yeah, all will with larger orders.
most of the problems that I think that people are experiencing are things that get solved with scale. Where like if you've got a couple hundred machines, it doesn't make any sense to have any of these services. Like it's too much additional burdensome cost. But if you've got tens of thousands, then I think this is going to happen as you start to see scale increase. You're going to see a lot more services being provided. And I think the other reason why you're seeing a lot of these services being provided is specifically because manufacturers are not able to compete on, it's one of the few grounds that are left for manufacturers to compete, right? They have to compete on service because from an efficiency standpoint, I mean, there's really no difference between a top end Bitmain machine and a top end MicroBT. Like you're basically limited by the physics of the chips themselves, and they're going to either the same fab or very similar, where they're getting their lithography equipment typically from the same company. So it's really the only place that's left to compete is sort of like deal structure, customer service, balance sheet management, and not nearly as much from a technology standpoint.
Quickly on the topic of competition, do we so there's Canon, Silicon, and eBang that seem to be in this kind of tier 2 manufacturer bucket that no one's
wait. Is it eBang or eBong? Come on. What's the consensus?
She bang.
Or is it eBong?
If you're in Colorado, it's eBong.
Come on. It's eBong, isn't it?
It might be.
So, why do any of your miners say to us in Corsair, do they go through an investment decision and look at these other manufacturers, or is it simply Bitmain what's miner? And do these who would buy these machines, and do they have a chance to compete in the future, even if they are at a lower price and have similar ROI or payback profile?
Well, that's a double-sided question. One is our own self-mining, and the second is our clients. And on our own self-mining, 100%, we've got an R&D sandbox that we're testing probably 15 different new units that are coming to market shortly. On the client side, we basically ensure that we've got the appropriate racks and plugins and monitoring software and teams that know what they're doing to make sure that their units actually operate properly. So it's a very different side of the coin when it comes to that question. When it comes to our own, it's absolutely stability, access to parts, uptime guarantees from a unit that we are able to test. So yeah, I mean, we definitely do test out. But we're mining on several different manufacturers. I won't name them because my glass is empty and I'll have to fill it up.
There's only 4 anyways, so I think we.
It's Bitmain.
Hey, no more excuses, TK. You got to fill that one up.
By the way, pet peeve about this industry, since we're talking about manufacturers here, I have yet to see a serious breakdown of the technical characteristics of the different miners. I mean, they publish a hash rate and crap like that, but I want to know how long does it take them to switch work units? What is the failure rate over time? Any of the big miners could publish this information, and I think it's in our best interest to do so, to squeeze the manufacturers.
But it's in their best interest not to publish that. So.
Well, is anybody under NDAs
for that,
prevents
right?
you?
But you don't need the manufacturer to publish that information.
You don't.
It's a good point.
Large co-location facilities to agree to share research information with extracting customer data.
But also, if you are the person or the larger entity that's doing that study, is it in your best interest to share that? Probably not.
Well, no, it's in everybody's best interest, right? If you can better identify which miner is less of a headache, requires less maintenance, etc.
But if you're the one that has that knowledge and you choose to not share it with everyone else, then it's in your best interest to keep that information to yourself.
Well,
yeah, we don't take strong U units anymore, by the way.
Mining is ruthless.
Strong U we won't touch anymore.
Let your competitors deal with faulty machines. Don't tell them.
Right.
Well, I mean, I don't think there's anybody that has one of every single miner ever manufactured or is available on the market, right? This is going to take an aggregation of different parties to actually write such a report, and I think it would be valuable for the industry.
But
These kind of reports do exist in other sectors.
It would be a good institute to start. Sorry, Amanda.
No, I was going to say it's not just about the machine though. It's about where you're running it, like what the environment is you're running it in. So you can have a machine in say Texas and a machine in like Montreal, and they could have very different.
You can normalize for that.
Well,
Pretty easy to
Not
normalize.
really, because even like you'll see a difference in petahash if it goes up to like 90 degrees somewhere.
Yeah, that's just temperature. You can normalize it
Yeah,
out.
or there's salt water in the air.
Yeah.
Yeah, so I think that there's it's not just a climate thing, it's also a building design thing, right? So
Absolutely.
you can have, you can design your building to have any sort of tolerances in any climate. It's just a matter of what engineering solution that you need to use to be able to achieve that. So depending on what volatile conditions have been maintained in that whatever facility, you can have drastically different server lifespans. And
Agreed.
the thing is, but almost all hosting facilities today have relatively low control over things like humidity, which in basically every climate does occasionally go to 100%. So even just, you can have some extreme weather event or something that can take and have a significant amount of damage to a batch of miners that is incredibly localized. It could be just one facility someplace. And depending on what distribution of equipment you have around the world, that could be, that could really throw off some statistics there. I think the other part.
There's certainly cyclical variation, but there's only two measurements to do, right? One is temperature, one is humidity, and the other is...
No, there's dust. Dust is a huge factor.
Particulate matter is massive. Oh my gosh.
Yeah.
You can have all different types of particulate matter too, right? You can have organic particulate matter. You can have pollen. You can have dust, conductive dust. You can have air. Like you can.
Okay, let's leave conductive dust out. That's just mean.
No, it's not. I mean, it's a real
forest
it's real.
fires, man. It's been the particulate matter in Colorado the past like, couple months. Nasty. You don't want to mine in that. That's awful.
You can even see stuff like industrial waste left over from aluminum smelters, where you'll have, like particulate that was there before that gets picked up over time, and it's more conductive than other dust that would be in an area like someplace out rural that hasn't had that. And those can be massively complicated. And they, in data center design, you can control for all of that. But today, almost no one does. And it's because it costs a little bit more money to do so. And there's not an incentive alignment. If you're a hosting facility and you have a 1-year hosting contract with somebody, why would you put upgrades in that are going to help extend a server lifespan from 18 months to 3 or 4 years?
It's along the lines of what Bob was talking about earlier. Sorry to interrupt, but like the diminishing returns. Yeah, you can make it perfect, but at what cost?
Well, I just want to get a lot of data. Like, I wish I had a feed on all this data. Give me the temperature, give me humidity, give me whatever you got about particulates, and feed that all in, and we can crunch that data and come up with some pretty interesting numbers. And as far as I'm aware, nobody's done it. And you guys, all your arguments you just made are telling me why it hasn't happened yet.
Well, I think the other thing to consider on this is that I don't see large scale mining taking a big of a risk of like allocating a huge amount of ASICs to a manufacturer that they haven't worked with before, or that doesn't have good data, or isn't top of the line efficiency, or doesn't have the top of the line reputation.
How do you know?
Well, I think one of the big reasons for this is that there's not a ton of differentiation in terms of efficiency and economic pricing. These lower manufacturers may have a little bit better pricing, but that's going to be proportional to that risk, right? And if you're a large miner in the US, say you're institutionally backed, why would you take a risk that potentially all of your capital, of your ASIC capital, could go away for a 5% difference in terms of?
My point is that there is zero quantitative measure of exactly what risk it is you're taking.
No, that's totally true. There's very little quantitative measure there, but then say that you even want to go about gathering that data, and you have to get enough scale of a bunch of different ASICs. Like, you're really only going to gather the ones that you think are realistically that you would use. Like, there's a long tail of Chinese manufacturers that make all sorts of off-brand or white-labeled machines,
clones.
Yeah, and if you're a big institution in the US, why would you take the risk on buying one of those when they're really?
Look, if the question is like, why would I ever take a risk on that? This is something that very quickly results in a monopoly or an oligopoly, right? Because nobody wants to try the new manufacturer. In this industry, this is intended to be a distributed, decentralized currency. We need new miners and miner manufacturers to enter, or we're all screwed from a centralization standpoint, because we're all centralized around the manufacturer, right? So having an even playing field of measuring that hardware helps us all in obtaining a new manufacturer.
Would you guys? Sorry to interrupt, but would you guys agree that like right now is like almost peak manufacturer as far as ASICs? Like we're almost in this like mining renaissance. I've not seen this variety of capability and efficiency and like I don't know, reliability. I don't know, whatever you guys were talking about. I feel like there is a ton of options that 5 years ago there weren't, or 3 years ago there weren't. 5 years ago there was some scammier options, but I don't know.
Depends on what you're mining, right?
Let's go TK then Ethan.
Yeah, I mean, it really depends on what you're looking to mine. I mean, I think right now there's a ton of really strong teams on ASIC development on non-SHA-256 manufacturing equipment. We've got a ton of equipment in our lab right now that we're reviewing.
Drink.
That's because SHA-256 is too easy, right? But everything else is also worthless.
But there's a ton of competition on SHA-256 and a lot of engineering teams that are very strong, that are very far ahead of the existing competition. So it'll be difficult for a new scale startup to get to where the existing incumbents are. But on non-SHA-256 coins or tokens, whatever you want to call them, there is a lot of opportunity for wiggle room for new entrants to come in, and then eventual consolidation, which is what I think will happen.
I think Ethan might have some interesting ideas here. You've dabbled in the alt POW landscape.
This is Bitcoin Magazine. Don't label me as a shitcoiner.
Would never.
Hey, you are who you are, man.
No, but I agree with Taras. Like, it's honestly probably the best place to start as a manufacturer because it's less costly to make mistakes. You can go and launch a machine in an altcoin and face less competition, and it's like playing in the minor leagues, working your way up to the major leagues. So there's a lot of good manufacturers that maybe their end goal is Bitcoin and SHA-256, but they realize that a better approach right now is let's go build a really good ASIC for, Siacoin, for example, like the Epic blockchain team out of Toronto. And then maybe we'll have a Canadian-based Bitcoin mining manufacturer in like 5 to 10 years from now. And then, so I think that's a pretty good approach. But going back to like Bob's point on ASIC decentralization, I also think this is a really big and important thing for the industry. And that's why I was kind of talking about Silicon, Canon, and eBang, or eBong, is because I think that if they do have the right, products and services in place, that people should give them the chance at the right price. If you can, determine that, okay, this is actually going to have a higher payback period. Yes, it comes with additional risks of like uncertainty, but it has a higher payback period. At least it's worth your investment consideration. And maybe they do need to improve on things like the repair center. It seems to be important, like, Amanda was touching on it earlier, like the importance of that. So if these kind of tier 2 manufacturers can develop those types of services, I think it's going to be really good for the industry because we'll go from 2 manufacturers to 5 pretty instantly if people actually start taking them seriously.
So I have a question here on this exact topic of ASIC decentralization, and it's a question that is born out of complete not knowledge and ignorance, but I remember not that long ago a story coming out of a researcher who found that there was a kill switch, or a potential kill switch built into an ASIC miner, from XYZ mining company that you have to drink if you say the name. So my question is from a risk standpoint, a risk profile standpoint for Bitcoin, say China, unwitting to us, forced 2 of the biggest mining production companies, manufacturers, that's the word I'm looking for, to building kill switches, and were able to flip a switch and take off those top 2. How screwed would Bitcoin be in that situation?
Yeah, that would be pretty terrible. Kind of like Sun Microsystems building in the secret chips that allowed backdooring into anything that was going across their network gear for the past 10 years.
I just think the secondary market would become more fruitful. Like, we would just use machines that were already used before that maybe there wasn't a kill switch on.
Well, keep in mind also that these devices are not that complicated, and for that specific device you're talking about, alternative firmware has been written and is being used in
absolutely
wide scale today, and that's what would happen. Hopefully, if we could reverse engineer it. If they could prevent us from reverse engineering it, that would be bad, but that's hard to do also. By the way, is it worthwhile to tell the ASIC boost story here about what you're talking about, what happened?
Sure. Yeah, story time.
Story time. Anybody else want to tell the ASIC boost story?
Oh, go ahead.
No?
Let's
Okay.
Can you do it in 3 minutes though? That's the challenge.
All right, 3 minutes. All right, ASIC boost was a technique. It was patented. It's a means to essentially make the SHA-256D computation a little bit faster because you pre-compute part of the SHA-256 computation, and it gives you up to about 30% theoretically performance boost. All right, this was patented. This was widely regarded as a bad move, in the words of Douglas Adams. And a certain manufacturer decided to actually use this. Now, what it required on the Bitcoin side of things was you needed a extra way. So in the Bitcoin block header, you have the nonce and you have the extra nonce. And you needed a different way to shuffle around what you were mining, right? So the nonce is the simplest way. It's just a number, right? You try 1, try 2, try 3, and just go through the whole list until you tried them all. What the ASIC boost did was require you to rearrange the transactions in the block to change the Merkle root of that block, such that, if I remember correctly, the first like 16 bits or something like that were the same. And so there was this grinding that had to happen on the computer to grind the transaction set in order to get another transaction set, which would result in a collision on the Merkle root hash. Anyway, long story short, the introduction of segregated witness caused this to not work anymore because it changed how transactions had to be committed to in the block. And it caused the entire ASIC boost algorithm to not work. This is called covert ASIC boost, by the way. There's another version of ASIC boost where you can essentially do the same thing that the patent describes by rolling the version field of the Bitcoin header. Covert ASIC boost does the same thing by rolling the transaction list, right? So basically what was happening, or what was claimed to be happening, was that a certain manufacturer was actually doing this in their own mining farms. They did not sell this feature to any customer. They removed the feature when they resold their used ASICs to you, which a lot of you probably have in your warehouses. And so they essentially gave themselves, 20-30% boost over everyone else. This was a huge part of the Bitcoin Cash, Bitcoin SV split because they fought tooth and nail to prevent SegWit from being deployed because they had $1 billion of sunk costs in this specific algorithm and this specific hardware.
That's the best.
Kill switch was a separate question, by the way.
Yeah.
The kill switch was called Ant Bleed, and I'll just say their name because I want to drink. Bitmain. God damn.
That was the best
After
3-minute
that,
synopsis.
the kill switch was claimed. But anyway.
I have
They
no comment to
pre-ROI'd
anything that
our
was just
machines
mentioned.
for us.
Say it again, Ethan.
They pre-ROI your machines for you. You don't even have to worry about ROIing them. They're already ROI.
That's how you know they're good.
But yes, there are any number of things a manufacturer could do that we might not like as an industry, right? We need a diversity.
I personally think it's less likely that we'll see diversity coming from lower tier manufacturers becoming one of the bigger manufacturers, rather than I think we're going to see legacy manufacturers step into Bitcoin mining.
I was about to say that when Samsung and or other players.
And I think there's a number of reasons for this. One, SHA-256 is a simple algorithm, so there's not a ton of optimization to be done there relative to like a CPU or a GPU. So there's plenty of people that can make those types of ASICs. But the way that these manufacturers compete, it is on a number of different fields. And one of the biggest parts is balance sheet and relationship with the fabs. So being able to reliably get an allocation of fab space, what is the cost that you're paying for that fab space, that kind of stuff is going to make a huge difference in terms of your profitability. And I think that's one of the main reasons why you see manufacturers sink or swim, is how well are they able to manage their balance sheet if they're looking at putting R&D dollars into new processes, still getting enough allocation at the fab. And then the other problem that they'll have a lot of times is that like you're getting this allocation, you basically have to immediately sell this set of ASICs. And if Bitcoin price goes down and you have to sell those at a lower price, you may not even be able to recover the amount that you paid in order to manufacture those. So I think we're maybe a little bit unfair to the manufacturers when we say that they're raking us over the coals, because none of us are there to go bail them out when Bitcoin price goes down and they have to sell machines at below cost. So like I think miners have too high of expectations of, if the manufacturers just sold a constant price all the time and you looked at the sales volume, miners would buy all of the machines. They'd sell out instantly anytime it's a good deal. And anytime it's not a good deal, they won't buy any of them, which is why the manufacturer will then adjust the price based on how quickly people are buying them. And it's us that bid up or bid down the machines. It's not the manufacturer that's like throttling the price up and down on us. If during the bull run in 2017, Bitmain didn't increase the price of S9s, there wouldn't have been any for anybody to buy. Like one group would have gone and bought them all immediately.
Yep.
Well, and then there would be people who came in and bought them all with only the intention to sell them again.
Yeah,
there'd be a huge resale market for like immediately after purchase.
Sounds like hand sanitizer. You're telling me the market price actually efficiently allocates products?
Crazy,
Sounds
right?
like sneakers or any other scarce product are good out there, right?
No one tell the government. They'll never
That's
believe
a
it.
very, very good point. I complained earlier that they were raking us over the coals because they price it proportional to the Bitcoin product. But what you just said was that that's going to happen anyway, and you're absolutely right. There are certain markets where this doesn't happen. Concert tickets is an interesting example. They try to keep the price constant, and they don't do any kind of demand response, and then they end up with scalpers, right?
Exactly.
So yeah, we're going to get that anyway, and I guess we just have to deal with it. But increase the number of manufacturers would.
So I think the big thing here is that if miners want to pay a more consistent price for machines, they have to buy machines that aren't going to get delivered in the next 3 months. You have to buy machines that are out 6 months, a year, where you're not competing with the rest of the capacity, because the short-term capacity is fixed. Like they've already had their allocations of that. They're not going to be able to drastically change that capacity. So you're competing against every other miner that's trying to buy that machine and plug it in at whatever the next hosting facility is for whatever revenue is right now. And I think miners are going to, if they want to have a lower CAPEX, they're going to have to take a slightly longer term approach and buy machines that are
a longer term approach, right? Like we've seen.
Yeah, no, you're still not seeing this in the. I mean, we're just at the very beginning of miners starting to think long term, and this is for good reason. I mean, if you look historically, long term thinking would have killed you. Like you had to be a short term thinker that could just get machines and immediately get them plugged in someplace, and that's a huge part of the reason why we see such a concentration in China is that if they can build super quickly there. And all the manufacturers are there. So if you're competing on who can get a machine plugged in the fastest at whatever amount of scale, they're going to kill at that.
What percentage of profit, this is just a really quick question, but what percentage of profit for miners do you think is lost in the, let's say, 2 weeks that it takes for the mining rig to ship from China?
Well,
I mean,
not even percent. You can calculate it directly. What do you mean percentage? I mean, it's 2 weeks times the hash rate divided by the hash rate of the mining equipment being shipped.
But you don't say like I want machines and I'm gonna get them in 2 weeks. Like it's like now it's a month long event.
But as you're waiting for that month long, people in China are plugging in the machines and the hash rate shooting up.
Yep.
I mean, it's obviously less impactful if there's a 4-year lifespan on the machine. Then it's not insignificant, but it's very small. But it's still definitely a consideration. Like as soon as S19 ship, I mean, that adds a lot of hash rate to the network. We just saw that massive hash rate run up. So if you got your S19 at the end of that cycle, that's very different than if you got it like a month ago when hash rate was down a bit.
And on that same note, if hash rate is ever increasing, which year over year we see that be the case, then that machine with a constant hash rate is going to have diminishing returns as measured in Bitcoin over time. So those first couple weeks, maybe it's a couple weeks, maybe it's a couple months, who knows, early on it was much longer delays to get ASICs, but those couple weeks or couple months, those will be the most profitable as measured in Bitcoin. And so they are absolutely typically, I don't know, they're very critical, the first couple days or months or whatever.
Absolutely correct. And I think everybody on this call knows, a certain manufacturer, every single machine you bought for them for a long time, and maybe it's even still true, was 6 months old at the time you bought it. They plugged it in and burned it in or tested it for 6 months prior to shipping it to you, because they were taking advantage of that.
It's Bitmain again. Goddamn.
I'm gonna make you Drake, not me.
We're the ones with footprints on them. That was awesome.
Well, on the topic of nefarious activities, you guys think that the manufacturers have been able to manipulate or influence the Bitcoin price at all before the sale of their machine, so that they go on sale, you go check how long it takes to pay back the machine, and it looks better than the day prior.
Look at what Bitmain did with the price of Bitcoin Cash and Bitcoin during that like 2017, 2018 timeframe, and I think you'll find your answer absolutely yes, absolutely yes.
So I would actually jump in here too, Ethan. I'm not an investigative reporter, but when I was playing around with some old articles on Bitcoin Magazine, I did find an interesting thing that was that back at the end of last year, Bitmain was selling miners, cheers, and in order to incentivize people to buy those miners, they were selling it was either 5 or 6K Bitcoin price call option or put options in order to like protect your upside or whatever in Bitcoin price in case it went down. And those were set to expire, I think, like somewhere around March, April. And if you look at when the Bitcoin price tanked back in March, it was immediately bid up to right over, I think it was the 6K was the strike price of them. And it was bid up, and there was a war. You could see it like jackknife down below and then come right back up right above that strike price. And I wonder in my little tinfoil hat if that wasn't a war that they were playing, trying to make sure that those put options didn't end up executing.
Underwater.
Yeah.
So I don't know about that part specifically, but I think on the other part about like Bitcoin price going up before they release a batch of miners, I think there's another simple explanation for that. So imagine that you're a mining company and you're mining on these machines and you've got however many megawatts of your own mining. If the price of Bitcoin suddenly jumps up, that's a really good time for you to liquidate all that inventory.
Yep.
So I think that the causality arrow there might be pointing in a different direction.
But the tinfoil is only one direction, right?
That's a good point. On the related topic, like, what does everyone think of these like mining inventory trackers and like miners' influence on Bitcoin? Impactful, medium impactful, or not at all?
Sorry, we lost you there. I think half your question was.
Yeah, try that one again.
Bitcoin price in a big way. My question was on this miner inventory tracking.
All right, I'll try to translate. You guys, who's been following
Miner
inventory
tracker
tracking?
Inventory
And is
tracking.
that gonna affect Bitcoin price?
Do
All right,
miners
TK.
influence price?
I do think that
Ethan,
miners.
you struck out, bro.
I think that
It was a valiant effort, but I mean, inventory tracking is extremely important right now, especially when you're looking at the constant march of difficulty as well as hash rate. I mean, right now, access to high quality silicone, production capacity, tariffs. I mean, these are all things that everybody that's tracking Bitcoin and doing economic analysis on mining should really be following closely.
I have an idea. Blockchain that thing.
Bob, this
Blockchain that supply chain.
is Dean. Please,
It's
Someone
the
hit
perfect
me.
candidate.
for everything.
You got to put the ASICs on the blockchain.
You get a blockchain. You get a blockchain.
Everybody gets a blockchain. Can somebody say BitConnect?
In all seriousness,
BitConnect.
So guys,
in all seriousness, like supply chain blockchain tracking is actually a thing. Let's use
No, it
freaking
should
open
be.
timestamps and have them put the data in there or something.
I don't think the weather should be tracked on the blockchain,
What
but
about the
Let's
line?
leave BSV out of it. They're crazy.
whoa. I didn't mention any names.
So guys, I have a question. Who would agree with this statement? Difficulty futures have a natural market fit with ASIC manufacturers.
I agree with that. So I think this might be a little shout out to Bitcoin Tina, but he claims that miners and ASIC manufacturers are on the opposite side of the difficulty futures. I don't know, just throwing that out there.
Yeah, of
Oh,
course.
absolutely they are, right? And that's
Natural.
that is an indication of a healthy and mature commodities market, right? When we talk about institutionalization, the things we were just talking about, the price going wonky because somebody has something expiring, right? That's what happens in the early days when things are immature, right? As things get more mature, more people know about that. They hedge it, There are professional
Exactly.
risk organizations like
Exactly.
Citadel and Susquehanna, whose their whole job is to hedge out those kind of risks, right? And this will happen in this industry. Citadel and Susquehanna will be trading derivative instruments on manufacturing of Bitcoin ASICs in the long term, and that will be an indication we have grown up.
I'm very pro derivatives, but I don't think manufacturers will go take a difficulty future. And the reason is because a difficulty hedge is hedging the market size. It's not hedging their commodity value. And so there's so many different ways that difficulty can get influenced that doesn't directly impact their revenue. So their revenue could decline and network difficulty still grows because either they're losing market share or there's older generation machines coming online or Bitcoin price runs up. And now suddenly you went short difficulty. You're on the wrong side of that bet.
Well,
and
there are
you
two
lost money
things to
on your
hedge.
derivatives bet and you lost money on your revenue as a manufacturer.
I think the market.
Fundamentally, there are two things to hedge. One is the Bitcoin price, and the other is the difficulty, right?
For the
if I have
manufacturer?
those two instruments, for anybody, manufacturer, consumer, miner, investor, energy producer, anybody, those are the only two instruments you do. Those are the only two variables.
I think the market share one is important. I think that
Market share is difficulty.
No. Think for example, if you're say you're one of the manufacturers and you have 30% market share today, if even say that you're on the right side of the difficulty bet, right? If your market share drops and you don't actually get to sell that many units, then you have now just double lost.
You mean as a manufacturer?
Yeah, if you're a manufacturer.
Market share as a manufacturer.
Yeah, if your market share is a manufacturer, like say that you don't get the allocation that you need at the fab, or say that there could be a number of complexities there that happen that make it to where even if the market size increases, you may not actually sell more machines.
Yeah, if you fall out of favor, if a bug is found, etc.
You
There's
may
all sorts
I
of
think it's so many examples, right? Like that would be like an oil producer, instead of hedging the value of oil, they're hedging how many barrels of oils are produced a year. And so if you're like some oil producer in Texas and now suddenly Saudi Arabia and Russia start pumping oil and you hedge through market size versus the actual commodity price, you could get really screwed. It's not a hedge instrument at all. Difficulty for manufacturers.
But I think there's a limited amount of applicability to it, right? So like I think generally directionally, you are going to see in general, you're going to see the miner manufacturer profits go up with a difficulty hedge, but I don't know if that correlation is going to be strong enough for those to be really useful, especially at the sorts of premiums that you see in the market.
I'm very surprised what you guys say. All right, so your thesis is that the difficulty hedge is not a useful instrument for a manufacturer. Betting in either direction. So we can argue about the direction, but I find that very hard to believe, right? Because their demand for their product is proportional to the difficulty, or inverse proportional, depending upon what's going on in the market.
Well, but that's not a direct relationship there, right? So if hash rate went up,
that's all I need.
well, like say hash rate went up, but like hash rate went up because one of your competitors sold 3 times as many machines as you did, then that hedge didn't help you in that case. Like you still have the fact, like if there were just one manufacturer, if there's just one source of increase in difficulty, then yeah, definitely. If difficulty goes up, that's because you made money on it.
Okay, so those are market dynamics that are not usually hedged in commodities markets, right? If I have two producers of oil, right, the derivatives market takes care of the price of oil, but it doesn't take care of the relative size of the two producers of oil, right? Those are generic market risks that any business takes on, right?
Yeah, but I think there's a difference here in that, okay, if you're hedging the price of oil and you produce X barrels of oil, then that is the amount of revenue that you get, is barrels times the price per barrel. But if you're
a different calculation, but
say that you're a miner manufacturer and your hash rate goes up, and hash rate goes up by 20 exahash, but you didn't sell 20 exahash, then you don't have a direct connection to difficulty.
The slow nod. That's ours.
Yeah.
Who's following this?
Wait, change the channel?
Yeah, I do want to change the channel, you guys.
Change the channel.
Let's talk about mining shortcomings, right? Like, where has the mining, where is there room for growth in the mining ecosystem? I think this is something that we've touched on a little bit, but maybe not directly. Professionalization is something that jumps out like immediately as something that is a shortcoming. Like, how far away are we from, maybe what enterprises expect as a level of professionalization is, or is Bitcoin mining always going to be for pirates? Let's go to Amanda.
So I think that there is ways that we can create financial products to help miners become more real in their operation and hedge out their risk, etc. So that was one of the reasons why I joined Galaxy, because I thought that I could create some tools for miners that would be able to help them become like not as piratey, more like businessy. So that's one area that I've been spending a lot of focus and time on.
It's called privateer.
Privateer.
Piratey.
Piratey.
I mean, I think this is an area
opportunists
that is getting a lot better, but still has a lot of room to grow. Like, think of a few years back, how did you do custody for a Bitcoin mining operation? Like, there weren't really good platforms for that. Like, now you've got Bakkt and Fidelity, and you've got like real people that you can go and do custody with.
Yeah.
But even a few years ago, what you had was like either one of the founders has a key on a hardware wallet that's locked in a safe somewhere, or maybe you've got like a multi-sig thing. Like, that is a big hurdle. There are a lot of hurdles from that sort of standpoint that I think have been cleared. I think it's still going to take a while for institutions to come in to the point where you see all of mining be really institutional. Like, eventually it'll get there, but I think in the next couple of years, you're going to start to see some like large portion of mining be more professional, institutional.
Well, I'll tell you the complaints I have heard over and over from investors and institutional investors is that they simply want to see, accounting. So, there's something very simple all miners can do to solve this problem. Hire a freaking accountant, hire a lawyer, make ironclad contracts, figure out what the investors want to see in terms of reporting, whether it's a monthly report or a quarterly report, a P&L report, whatever it is, make those reports, and you're going to be good. I think too many people, and you said the points about like multi-sig custody and things like that. I know a lot of miners have screwed up custody. When there are multiple parties involved, that's easy to do, but we can't afford to, right? To be professional, to be commercial, be institutional, you can't screw that up. You have to have a well thought out process, and you have to have a legal contract backing up that well thought out process, and an escape route if all that fails, right? That's what an institutional investor wants to see.
Yeah, no, I totally agree with that, and I think there's a couple other points there that are interesting as well. If you look at like you need a certain amount of scale to be able to afford institutional quality. Right? Yep. You can't have 24/7 security. You can't have all the auditing and reporting and everything on 5 megawatts of mining. Like, you need to have large enough of a scale of operations to be able to support that, and it is an extra cost. So if it doesn't give you access to institutional capital, there's no incentive for you to do it. The only incentive for you to do it is if you are able to get that additional capital in. So I think that's a big part of the reason is that like the miners that exist today are generally not institutionally backed. So why would they spend this money on something that that their investors don't care about and just is going to be harmful on their returns?
I would argue that that's going to change over the next 24 months in a big way. I think that a lot of the mom and pop shops are going to get sorry, I put my hand up just to be courteous. Canadian, I'm in Toronto right now. I think a lot of the mom and pop shops are going to be shut down, even if they have access to cheap power, because OPEX is going to be a big turning point. So the requirements for having a management team that you can find on LinkedIn that has a real track record, that is KYC'd properly, I think these are all things that are very important, that are going to really create a wedge between the pirateering that's happened in the past and what will be securing the network into the future. I defer my time to Amanda, who's got her hand up as well.
I was for one teasing you, but also thinking about it in terms of there's this tug of war, right? Where we want miners to be super institutionalized and have this 24/7 security and have all the features and things that we want. but we also want 2-cent power. Like, how do you do both?
There's a difference though. You when you pay for 2-cent power, you get 2-cent service, right? And that means like you're literally needing to send your own people to fix your own damn machines, and there's no fleet management, there's no automation, there's nothing.
Yep.
And you're paying for that 2-cent power. When you're paying for a premium service, like you actually have to spend a little bit more to ensure that your machines are taken care of properly, right?
Yeah, and that's why I called it a tug of war, right? Because like you want both of those things, and there's no way you can have both of those things.
Exactly.
Well, there is a way that you can have both of those things, which is scale, but nobody has that today. Like the
well, it depends on what you mean by scale. Like a gigawatt or more, 500 megawatts or more, like 100 megawatts or more. Like, what do you consider scale?
But isn't it heading in that direction? Like 2 years ago, turn of 2018, like you couldn't even find 2 megawatts to host your machines in, let alone like huge enterprises available for 5 cents. And so the fact that we have like really good facilities out there with cheap power, maybe it's not 2 cent, but it is like, in the realm of 5 cent, like that's an incredible step that our industry has taken. I would assume that in 3-4 years from now, we're going to start seeing that good of service down to 4 cent, maybe down to 3.5 eventually. I think we're heading in the right direction.
Heading in the right direction. I don't know about that type of cost compression in the next 3 to 4 years. I mean, the whole thing is there's a fixed cost on actual infrastructure when it comes to large scale power generation. So there's an asymptotic curve that eventually flattens out as we get to that type of scale. But that could be an entire 2 hours without wine that we could talk about.
That was like 2 episodes ago. There was June Seth just like telling David Bailey, no, it does this. It does this. So you can go and watch that episode. It was great, but it was pretty
excellent.
Much 2 hours of that.
Wine included too. So.
Yeah, boxed wine and everything.
And the reason I say that is because we're in an era now where I'll have to drink for like North America here, but we're competing with areas like Venezuela and Kazakhstan and Iran, and who knows how much government subsidies there's going to be in those countries. So if we don't head down that cost curve, we're going to lose percentage of market share to all these upcoming countries.
So wait, I have a question about this, Ethan, and then let's go to Cassie. But countries that are subsidizing energy in order to bring in mining, or maybe it's not like what their stated goal is, but it's what effectively they're doing. Are they, in effect, just hastening the devaluation of their own currency? Or is there a greater play there?
Depends on how much Bitcoin they get out of it.
I really think it depends, like on a country by country basis. So out of the countries that we can look at, like North Korea obviously mines a lot of Monero because they can use it like botnetting and access servers outside of North Korea to mine it, and they use that to avoid sanctions. Iran, maybe the government wants to avoid sanctions. And then you see places like China and Venezuela where it's more for like capital controls. But I think it depends like per country, like what the motivation is. In some countries, it may devalue their currency, and they probably already have strict capital controls though already. So it's hard to say until we look at a per country basis.
And the one thing that you have to consider is that when you're a large scale miner and you're committing hundreds of millions of dollars into CAPEX, heavy CAPEX intensive production, where do you think cost of capital will be lower? In a stable jurisdiction, or one where there's rule of law questions, jurisdictional questions, security questions? I mean, all of these things have to be factored into a discount rate when you're looking at, am I going to put my money here or here, right? So
I 100% agree with that point. I think that is one of the most underrated features of why you're going to start to see larger scale Western mining, is because long-term planning is possible here.
Well, look at gold mining, same kind of thing. Like, I came from the traditional background of like PGM, precious gold metals, right? Most of it now, there's a cost of capital that's associated with, mining in the Congo.
Yeah. No, I mean, like, think of just from the simple perspective of like, okay, if you can capitalize a machine over, 18 months versus 5 years, like that's a huge difference when machines are the majority of the cost of your CapEx. So no one's going to be sending new generation machines to Venezuela They're sending old generation machines that go there to die at super cheaply built facilities where they know that the machines are not going to last for years, but they don't care because all they're trying to do is squeeze a little bit of life out of that machine for whatever window of time that they think that they can get that cheap power. But no one's like, no one's building a enterprise quality data center that's going to be, decades worth of infrastructure.
And what you're showing is what Bitcoin gets to have its cake and eat it too, really, in like this department of, can Bitcoin get the state of the art and the super cheap pirate type people contributing to the network. I want to jump over to Cassie to give us kind of the last thoughts on this subject, and then after that, can you believe it? We've already hit 2 hours. We'll go to the last word and close out this amazing this amazing panel. But it was fantastic having you guys. So Cassie, why don't you close out mining shortcomings with a thought that you had before Brand's question?
Wait, hold on. Before
Actually,
we go to
let's
Cassie,
let Amanda.
Yeah, Amanda. Yeah, you got to jump off. Give us a final word, and then we'll go to Cassie.
Sounds good. Bye, guys. Thanks.
All right, thank you, Amanda.
Quick final word. All right, let's jump over to Cass.
Bye, guys. That's what it was. Yeah, I was just going to say that, I don't think that anyone is like from our market is really entering any of those markets like Venezuela or Kazakhstan, for example, is entering into those markets. There may be a couple of players that are doing that on a lower, a much shorter time horizon. But like Venezuela, for example, I don't think that there's anyone from, maybe I'm wrong, the United States is going down there to mine Bitcoin explicitly. You have to know who you can pay off in those countries, because essentially like there's a chain of command there that is completely unfamiliar to us, whereas like things follow some sort of regulatory structure here in the States.
That's where China gets an advantage.
Yeah, there's always someone you can pay off.
Kazakhstan's a bit different than Venezuela, though. There's no
right, it's very different.
There's no sanctions against Kazakhstan, and it's a great place to visit, by the way. Fantastic people, big fan.
Yeah, I almost made it up there from Kyrgyzstan, but not quite. So. Super beautiful in that area though. But yeah,
it's really nice.
The last thing that I'll say, because I know that we're hitting time and I want to make sure everyone has time to say something. I just want to say thank you to all of our miners out there for securing the network. Obviously, your incentives are definitely aligned, and you're getting something out of this. But we appreciate you, and it's super cool for y'all to be a part of the largest computing network in the entire world. So thanks for providing us with that security.
Keep hashing out there. All right. Well, thank you for that, Cassie. Let's go over to Bob. Bob, why don't you give the audience your last word, sir?
I have to have a last word? Uh-oh. I have to think of one.
All right. Let's skip you. We'll go back to you, Jesse.
I think we pretty much covered what we were going to cover there. I don't think I have any great last words here.
All right. Let's try to get a better effort out of Ethan.
On the theme of like different geographies and Cass's last words there, I think like all of us on the call, we shield North American hash rate, very much so. But it is quite important to get hash rate in places like South America, CIS region too. So, hats off to every miner around the globe, even if you're not building in the US, in Canada, like every build out is good for the network. So, continue to build in South America, continue to build in CIS region. That's great.
Is this good for Bitcoin? Yes. Tyler Bain.
Yeah, so I think we talked a lot about institutional miners here, which is awesome. I think, the space is evolving very fast. It's great to see. But I think my closing thoughts are going to revolve around small miners, the little guy. I think there's a lot of space in the Bitcoin network specifically for folks looking to spool up some hash rate and to acquire some coin. I think there's that, it's still possible. Folks are doing it every day. So, hash on, folks. Have fun. Glad to be here.
Let's go to TK, and then Bob, you can close it out for the show.
Something to say.
All right.
All right.
Good.
Well, I'm really happy and excited to be part of this space. What we're seeing right now with digital assets is what the web did to commerce, is what we're doing to financial institutions around the world. Miners are really the backbone of that. We're the pickaxes and shovels in the big gold rush of what's happening in the planet right now. So keep hashing, keep focused, and keep going.
Bob.
I hit all the main points I wanted to hit. I was trying to think of something here. So if you think about the last major gold rush in the internet era, right? It was the internet itself, right? So back in the late 90s, early 2000s, right? AOL started to come online. At that time, there were a lot of mom and pop shops. And I think there's an interesting analogy to draw between mining today and the mom and pop dial-up modem industry of the late 90s. And, you know, where they went and, you know, what that perhaps means for the mining industry. So, you know, back in those days, you know, the only way to connect the internet was via the phone line. You'd dial up and it would connect, right? And all of these mom and pops had grand ideas and said a lot of the same kind of things we are saying now, but ultimately they all got bought up. And how many of you have more than one option for your internet at home right now? I mean, show of hands. I have one option. It's maybe for the others, right? So everything got consolidated, right? That is not the value proposition of this industry. And I think if we are to succeed, we have to prevent that fate from happening to ourselves. Now, I think for many of us, this may be good. It will get more institutionalized, and I think all of us should work hard on institutionalizing, professionalizing, working on reporting, accounting, this kind of boring stuff, but that's what gets us over the threshold with institutional investors. But also think about what's the next thing. How do we prevent this industry from going the route of Comcast? You know, Comcast's the #1 most hated company in the world. Seriously, right? That's where the mom and pop. Yeah, that's where the mom and pop modem industry went, into the #1 most hated company in the entire world. This message brought to you over a Comcast line.
And Starlink.
Yeah, how do we prevent that from happening to us? So I leave that for you guys to think about.
Man.
Excellent.
Ending the call on the tough questions. I hope the game theory works out in our benefit this time around, but ultimately only time will tell. Thank you guys so much for coming down to the show. Thank you for everyone who watched. Please make sure to share. You know, this is a very, very dense show, and there's so much fantastic nuggets in this. So
I learned so much. This is great. Thank you guys.
Keep an eye out. Make sure to
Cheers.
subscribe to Bitcoin Magazine, and cheers to this fantastic panel. Peace.
Cheers.
Thanks again.
My wine is empty.